SunPower reported earnings before the market opened on Thursday and really provided, I think, a lot of information and context about what's going on in the solar industry right now. Revenue was down for the fourth quarter. That's not a huge surprise given everything we've heard from all the installation companies and also the hardware manufacturers. And SunPower raised new capital, needed to raise new capital. They had a going concern warning out. That was really the big thing that hit the stock over the last couple of months. And it seems like, at least for now, they have a bridge to the future. But there were a bunch of takeaways that I had from both that funding round as well as guidance for the end of the year. They're expecting to be free cash flow positive in the second half of 2024. So this kind of mirrors the comments that we've heard from companies like Enphase. But there were also some tepid things that I think investors need to keep in mind, like they're expecting hardware costs to come down. So if you're Enphase or SolarEdge or any of the suppliers to installation companies like SunPower, you should be hearing that and thinking, wow, maybe the margins that we had in early 2023 or in 2022, maybe those aren't going to be the same margins that we're going to see going forward, because I think a lot of those hardware components have really been commoditized. And remember, Enphase specifically has a tie to SunPower because it was SunPower who was part of bailing out Enphase, got an equity stake in the company and has sold that over a number of years. But these two companies are really tied together. So as SunPower has less exclusivity to its old manufacturing arm, it looks to diversify its suppliers for microinverters and batteries. This could open up more competition for a lot of companies that haven't seen a lot of competition in the market over the last 5 years or so. So I'm going to put that all together with SunPower's earnings. This is what I'm going to dig into today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, which is on the bottom of the page right here, they will give you their top 10 stocks to buy right now. So let's get to the high-level earnings report, and then I do want to dig into the financing round because there's some details in there that really show that SunPower didn't have a lot of leverage with their financing partners. This is a look at some of the earnings results. You can see that revenue for the fourth quarter, $357 million, was down pretty significantly from $498 million a year ago. Gross margin on a non-GAAP basis, which is typically what you want to watch. You want to see this be above 20% for SunPower, but it was 4.5%. So that's really bad for this company. Operating expenses were up. Adjusted EBITDA was negative. Everything else was negative. Just a really bad quarter all around. Again, not something that we weren't expecting from the industry. Some of the business highlights show at least where the trajectory of SunPower is headed. You can see that 16,000 customers added in Q4. You really want that number to be over 20,000 and more like 25,000. That was their guidance, was 80 to 100,000 coming into 2023. That's at least 20,000 customers on a quarterly basis. Obviously, they aren't anywhere near that right now, but they do have a pretty significant backlog of 15,000 customers that is primarily in the new home channel. Remember, in California, you have to put solar on new homes, and SunPower has been one of the market leaders in new home solar installations. That was a segment of growth from Q3 to Q4, up 19% in new homes. And then you also see, this is again something that we're going to see on a continual basis in California specifically, 76% attach rate for storage in California versus 23% nationally across all channels. This is going to tick higher. California is going to kind of be first. The net metering 3.0 really drives storage to be a little bit more economical. It makes more sense to be solar and storage as opposed to just solar like it was previously. And we'll see that move in the same direction nationally, but it's going to take a little while. Financing, something they talked a lot about on the call. They're moving more to leases because that's what customers are looking for. SunPower has always been agnostic with whether they're selling a solar installation for cash, loans, or leases. And so obviously with more leases coming along, they're going to need more financing options. So we'll probably hear something about that in the near future. Not a lot of real positive signs. The one big thing though was SunPower getting some financing that will actually bridge to this future when they can potentially be free cash flow positive in the second half of 2024. And here's the high level look at what that looks like. $175 million in total financing through a second lien term loan through Sol Holdings. This was the JV between Total Energies and Global Infrastructure Partners. Total Energies and these are the majority shareholders of SunPower. So these are the majority equity shareholders, and then they've also offered debt to SunPower. But the details are really where this gets interesting. So this is $45 million from a previously announced funding round. The loan is going to be in 2 tranches. One is going to be $125 million. And along with that $125 million, there are what called penny warrants, 41.8 million penny warrants for SunPower shares. In other words, to get this $125 million in debt, which does come with a high interest rate, SunPower also had to give up the right to buy shares for basically nothing, and that alone could be worth $3 per share. So the way that you would look at this if you're Total Energies is you're saying, okay, we're going to need some upside, so we're going to need either a convertible debt offering, so a debt offering where we have debt, and then if the stock goes up, we get to convert it to stock and participate in that upside, or say, just give us some free warrants and we'll participate in that upside anyways. So effectively, SunPower is getting $125 million, but in return is giving this joint venture $180 million worth of stock. There's another $50 million tranche for this term loan, but that comes with another $33 million worth of penny warrants. So I look at this and I see SunPower basically having to beg their sponsors for financing, and those sponsors really squeezing everything that they absolutely could out of this. So this is going to be extremely dilutive. And this is the reason that the stock went from being up over 20% at the start of trading on Thursday to actually down later in the day. I wanted to highlight just a couple of the terms. There's a lot here, but this is the SEC filing giving the details on these loans. And you can see here that the term loan facility has a 13% interest rate if paid in cash, 15% if paid in kind. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So there are some positive signs for SunPower, namely they're not going to go bankrupt, at least not right now. And management thinks with cost cuts that have been instituted recently, with increased demand, with more storage, with better cost structure, from a hardware standpoint, they're going to be able to turn this business around and be free cash flow positive in the second half of 2024. That's what guidance was for. But I think what's really concerning is the terms of the loans that were taken out. This shows that SunPower was in serious financial trouble, and that even their sponsors are effectively saying, hey, we will give you debt, but we want even more upside. We want to take an even larger share of the company if you do survive and ultimately thrive. That ultimately takes upside away from public market investors like you and I. So that's really the balancing act that SunPower is playing. So sort of a positive short term just because they're not going to go bankrupt. But at the same time, if they do recover, not going to be nearly as much upside. That is going to go to Total Energies. The other thing that I would think is worth noting is what management said about their costs. And this comes straight from the conference call. They expect to benefit in 2024 from new relationships with key suppliers, as well as lower costs of equipment, particularly panels. So panels is something they talked about in the past. They had a deal with Maxion Solar Technologies. That was their spin-off for solar panel manufacturing. And that basically put them in a position where they had higher efficiency solar panels than most competitors, but also higher costs. So they're going to be offering more types of solar panels through their dealer partners. So that's going to be one big change. But I think the other thing, if you're one of these equipment suppliers, and I mentioned Enphase, you could look at SolarEdge. I think all of these companies are going to be put under a lot more cost pressure by all of these installers, because SunPower isn't the only one in financial trouble. Sunrun is having its own challenges. We'll see what their results look like next week. You have Sunnova running into challenges. All of these installers are really at the front lines seeing the drop in demand for solar installations, particularly in California. And so as they do that, yes, they have to cut their operating costs, but they also have to cut their costs for each of their installations. And that means that they're going to put pressure on everything from solar panels to racking to inverters and power optimizers and batteries, the things that those hardware companies supply. So that's one of the things I want investors to take away from this, is that the installers, I think, are starting to look like a little bit better companies heading into the second half of 2024. But that doesn't mean that when demand starts increasing for some of these equipment suppliers, that margins are going to bounce back in the same way that they were in 2022 and early 2023. I think there's going to be a lot more challenges from the margin side for all those companies. So just a little bit of warning that we've now seen for the second straight quarter from a lot of these installers saying they're expecting lower hardware costs in the future. So that's a lot to take in, but what do you think about SunPower's results and the future of the solar industry? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.